Here's the most important concept in finance, and almost nobody actually understands it. If you invested $100 today and never added another dollar, you'd have around $4,500 in 50 years at the stock market's average return. But if you invested $100 every single month for those 50 years, you'd have over $1 million. Same starting amount, same return, wildly different outcomes. So what's actually happening? When you invest $100 at a 10% return, you have $110 after 1 year. Simple enough, but the next year you don't earn 10% on the original 100. You earn 10% on the new 110. So now you have $121. The year after that, 10% on 121, that gets you to 133, then 146, then 161, then 177. The interest itself is earning interest. The base keeps growing. That's compounding. Now here's the catch most people miss. There's another kind of interest called simple interest, where the original $100 earns $10 every year. And that's it. Forever. The interest sits in a separate pile, never earning anything itself. Year 1, 110. Year 2, 120. Year 3, 130. After 50 years, you'd have just $600. Compounding turns that same $100 into over $11,000. Same starting amount, same interest rate, almost 20 times more money. The only difference, whether the interest gets put back to work. Quick math check for the curious. The compound interest formula is A equals P times 1 plus R over N, all raised to the power of N times T. Don't worry, you don't need to memorize it. P is your starting amount. R is the yearly interest rate. N is how often it compounds per year. And T is the number of years. Plug in numbers, and you can predict any compounded outcome. Here's the most dramatic example of why time matters more than money. Meet Susan and Bill. Susan invests $5,000 a year from age 25 to 35, just 10 years, then never adds another dollar. Bill waits until 35, then invests $5,000 every year from 35 to 65. That's 30 years of contributions. Bill puts in 3 times more money than Susan. But because Susan's money had 10 extra years to compound, by age 65, Susan ends up with more. About $525,000 to Bill's $470,000. The first dollar you invest is worth more than the last one. Time isn't a multiplier you can buy back later. Susan and Bill is one example. Here's the same lesson in pure form. 4 people, all investing $500 a month at 7%. Person A starts at 25 and invests for 40 years. They retire with about $1.2 million. Person B starts at 35, same $500 a month, 30 years. They get to about $540,000. Person C starts at 45, 20 years, gets to $170,000. Person D starts at 55, just 10 years, ends up with about $53,000. Same monthly investment, same return, just less time. Rate matters too, but less than people think. $100 a month for 40 years at 1%, what a typical bank savings account pays, gets you about $58,000. At 3%, what you'd earn from CDs or short-term bonds, about $92,000. At 7%, close to the long-run stock market average, you get about $240,000. 4 times more money than the bank, just by choosing index funds instead of cash. The market isn't risk-free, but over 40 years, the math is hard to argue with. One quick note, we've been using yearly compounding, interest added once per year. But many investments compound monthly, daily, or even continuously. The more often it compounds, the slightly faster your money grows. $100 at 7% for 30 years. Yearly gets you $761. Monthly gets you $812. Daily gets you $816. The differences are real but small. Don't sweat the frequency, sweat the rate. Here's the trap that makes most people quit. The first 10 years of investing feel painfully slow. You put in money, you watch it grow a little, and the curve looks almost flat. The magic doesn't really kick in until year 15, year 20. Most people give up before they ever see it. The money you invest in your 20s isn't valuable because of how much it is. It's valuable because of how long it has to compound. Don't quit before the curve bends. One more thing about that 7% average. The market doesn't actually return 7% every year. It returns plus 30 in some years, minus 20 in others. The 7% is just the long-term average. Over 40 years, the math works out beautifully. Over 5 years, it might not. And the order of those returns matters too. A big drop in your final year hits harder than the same drop in your first year. Compound interest's promise still holds. It's just smoother in spreadsheets than in real life. One more thing you need to know. Compound interest doesn't only work for you, it also works against you. Credit card debt at 24% interest compounds the exact same way, except the bank is the one earning. A $5,000 credit card balance, paying just the minimum, takes over 30 years to pay off, and costs you about $18,000 in total interest. The same compounding that quietly builds wealth quietly destroys it when you owe instead of own. Pay off high-interest debt before you start investing. Let's put it all together with one realistic example. Meet Sarah. She starts investing at 25, putting $700 a month into a basic index fund, about 15% of a typical $56,000 starting salary. She does that every month, no matter what the market is doing, until she's 65. At the average market return, Sarah retires with around $1.8 million. She only contributed $336,000 of her own money. The other $1.5 million is compound interest doing the work quietly in the background for 40 years. But that $1.8 million isn't quite the full picture. Let's talk about what could shrink it. First, inflation. That $1.8 million is a nominal number, the actual dollars in Sarah's account. Inflation slowly raises prices over time. At 3% inflation per year over 40 years, things become about 3 times more expensive. So $1.8 million in 2066 buys roughly what $550,000 buys today. We call that a real return, adjusted for inflation. Most online retirement projections show nominal numbers, which look bigger than what you'll actually be able to spend. Always ask, nominal or real? Next, fees. 3 things quietly leak compound interest away. The first is fees. Most mutual funds charge an expense ratio, a yearly percentage of your balance. A typical actively managed fund charges around 1%. A low-cost index fund charges 0.05%. Sounds tiny, but over 40 years, the difference on Sarah's portfolio is about $400,000, gone to fees that compounded away. Fees compound against you the same way returns compound toward you. The second leak, taxes. In a regular brokerage account, you pay capital gains taxes every year on dividends and any sales. That tax bite slows compounding. In a tax-advantaged account like a 401k or a Roth IRA, your money compounds without that yearly drag. Same principle, same return. But Sarah's $1.8 million in a Roth IRA could end up around $1.4 million in a taxable brokerage. Same effort, much less money. Account type matters as much as which fund you pick. And the last leak, dividends you don't reinvest. Many stocks and funds pay dividends, a small cut of profits sent to shareholders every quarter. If you reinvest those dividends, they compound with the rest. If you take them as cash, they don't. Most modern brokerages have an automatic reinvestment toggle. Turn it on. Don't leave compounding on the table. One more useful trick, the rule of 72. Want to know how long it takes for your money to double? Divide 72 by your interest rate. At 7%, 72 divided by 7 is about 10. Your money doubles every 10 years. At 10%, doubles every 7 years. At 1%, it takes 72 years. That's the rule of 72. Finance professionals use it for quick mental math, and now you can too. 3 things to remember. 1. Start as early as you possibly can. Even small amounts compound for decades. 2. Minimize the leaks. Low fees, tax-advantaged accounts, and reinvested dividends keep more of your money compounding. 3. Stay invested through the ups and downs. Markets are bumpy, but compound interest's promise plays out over decades. That's compound interest, the most important number in personal finance. And now you understand it. Subscribe if you want more like this.